Good morning. Can everybody hear us okay? All right. So panel today on decoding derivatives. Derivatives, time and time again, have proven that they create an innate ability to make markets scale and make them more efficient. There's something about releasing the constraints of inventory on the ability for market makers to provide liquidity and the ability to create synthetic exposures to transfer risk over respectively space and time. And crypto is no different. And that's certainly a view that some very established captains of industry have taken. So with me today is Shaun, president of Cboe Digital, and also Payal, Shah, the head of cryptocurrency products at CME. And so they represent that first category of established players that are entering crypto from the traditional finance side. Now the crypto derivatives market has also had a very interesting history of its own native players that created derivatives markets, especially in the 2016-2019 era, where there were tremendous constraints in terms of access to banking, in terms of regulatory and clarity. And those constraints have actually created a lot of creativity and new contract structures to develop in derivatives. You saw inverse contracts, you saw perpetuals, you saw insurance funds. So a lot of innovation that actually took place to navigate around constraints. One good representative of that today is Deribit, who's become the largest platform for crypto options. And with us today is Shaun Fernando, the head of risk at Deribit. And so that presents a very other interesting class of players who are crypto native, started with retail, but are also increasingly relevant for institutional players in the space. So with that preamble, I'd like to kick off the panel discussion with more of a 12-month look back, because we've seen a tremendous amount of volatility. With late last year, the demise of FTX, which was then followed by actually the lowest volatility regime we've ever seen in crypto. So be curious to know how that was experienced inside these exchanges, what were customers doing, and what are they asking for over these last 12 months. Maybe Payal, I'll start with you.
Yeah, happy to kick off, and great to see so many familiar and new faces here. So really excited for these 2 days. So yeah, over the last 12 months, what have we seen? So I think it's probably 3 things that resonate the most, right? So flight to quality, without a doubt. After FTX, the need for regulated marketplaces that people knew, understood, and they could trust. And what does that mean, right? So for CME, that's our cash-settled, regulated futures contract. It's cash-settled, so you don't have to deal with the wallets or the barriers to entry are lower. Regulated on a CFTC marketplace and index-based, so not having different or too many spot exchanges that you might see outages. So that flight to quality, and we've seen that through FTX, where when there are cases of price discrepancy, that the need for price transparency, for markets to come onto a formulated venue, that has been increased. So that's probably the thing that we've seen the most. We saw that in FTX, where the volume that we saw on the days that followed FTX, our volumes increased to about 12 billion. On a regular trading day, we see about 4 billion done in notional. So it really highlights the case for liquidity in those markets. And we saw the same thing again following Silicon Valley Bank this March. The second thing we see really is the innovation in the space. So not just from our side and the other products that the exchanges are bringing to market, but really the broader ecosystem, right? So ETFs being a great segue or a great alternative tool that helps the ecosystem. So just last week we saw the ETF on Ether-based futures. A couple of years ago, the Bitcoin futures-based ETF. So really building out that ecosystem. And the reason that these ETFs, if you look at the ETFs that are currently in front of the SEC, I think out of the 11 that are in front of the SEC, 7 of those are based on the CME CF reference rate. And if we include futures, then 11 out of 13 are. So we're talking about 85% of the applications in front of the SEC are based on either CME or CME CF products. And that really shows that the industry is trying to build around those regulated products, so regulated futures, regulated indices, and overall that's showing growth. So the third thing that we've seen is increase in volume. So I mentioned daily volume, we're probably seeing about 4 billion traded across our products. So that's the institutional size contracts, so the standard Bitcoin and Ether, the micro size that we launched a couple of years ago that look more at, that try and cater a little bit more to the retail institution, the retail investor, and also our euro-denominated contracts as well.
Shaun?
Yeah, I think for the crypto-native exchanges, it was about more, as I would call it, self-regulation. So one of those things was proof of reserves. That was all the rage when the whole FTX went down, and using technology to actually, using blockchain technology to actually say, hey, we can be very transparent in where the assets are held and validate that for users real time. I think for us as a crypto native exchange, we can see that there's this demand from clients, like more, they don't want to get caught in another FTX kind of scandal. They want more rules, more regulation. That's why we are actually pursuing regulation with VARA in Dubai. And I think that there will probably be a fragmentation of exchanges that decide, okay, our focus is completely retail, and even I think retail are getting more and more demanding, but they might just go for a very, let's say, play that regulatory arbitrage game where they just get regulated in very dubious places or have no regulation and really cater to mass amounts of retail. For us, it's because we are 80% institutional. We have a large institutional client base, and we can see actually it's not just us onboarding clients, it's clients onboarding us. It's a big process both ways. And yeah, we just need to go in that direction because that is our focus. We have positioned ourselves for like the institutional market. I mean, options is really an institutional product. Yeah, with the sort of skill set that you require, you normally get, I mean, you've got like the market makers are very, very active in the space and have been active since early on. We see more and more adoption by asset management firms, hedge funds, especially from the traditional side. That kind of stalled a little bit during the whole FTX crisis as people kind of tried to ascertain what's going on, where are the chips going to fall, is this the end of crypto? But no, it's just another, I think crypto goes in this 3 steps forward, 2 steps back. And these kind of events just accelerate where crypto, the development of crypto, because these are kind of issues that in the traditional, in TradFi, they've actually been through just on a longer time horizon. These kind of issues with credit crisis, with yeah, just contagion risk and stuff like that. And yeah, I think it's in the long term for the better. And fail faster, come out stronger. That's I think a good place for crypto to go.
Yeah, great. And John, you were during this time busy with the embedding of RSX acquisition into Cboe Digital and also in talks still with regulators. So how was that experience over those last 12 months?
Yeah, I mean, I think to echo Payal's approach or thoughts, we see a tremendous shift in in kind of incoming institutional interest due to counterparty risk, flight to quality, a lot of kind of leaning towards maybe traditional financial sensibilities in the way you approach financial markets. Cboe Digital, we have a fully regulated spot marketplace and derivatives marketplace. So over the last 12 months, we've been kind of in the weeds with the CFTC on getting approved to offer margin-based futures contracts on digital assets. So there'll be a few more places to trade futures in the US outside of CME. So happy to bring more competition. And I think from our perspective, it's not necessarily about share, it's about growing the pie. I think institutions want more access to risk off. They want more access to put on positions. And a lot of them will look at it and say, I only want to be certain size of a certain market or certain size of a certain industry. And so having an additional venue that has the same governance, the same risk management, the same regulation, the same kind of trust and transparency, I think is really important to help grow the ecosystem. So we're hearing a lot of demand for that. And I think our experience with the regulators, whether it's in the spot marketplace, which is in the US state-driven, or at the federal level, they're leaning in more and more in this space, right? So it's not necessarily how do I continue to operate without regulation. It's you need to embrace it, right? And you need to educate the regulators, and you need to help them understand the innovations you may be bringing to the market, because I think they want to see the market grow as much as maybe some folks don't agree with that. It's just they have a certain way of viewing the market. It's grown over decades or hundreds of years a certain way, and so they're concerned, I think, at the innovation, but they want to see it done prudently. And so that's been our experience. Maybe a longer process than maybe the industry and we hope, but ultimately we're able to get over the finish line, and very excited about what we'll be able to bring to the market in the near future.
Interesting. Let's talk more here about product. And there, I think the interesting contrast between the crypto, the ones that started in crypto versus the traditional exchanges is the role of perpetuals. And Shaun, maybe you can talk about the role of perpetual offerings in an increasingly institutional market.
Yeah, so I think when a lot of traditional players came into crypto, the first thing they were like, what are perpetuals? That was just a mind-boggling instrument that was created, I think, mainly for retail who were not used to that whole idea of that something will expire and then you suddenly don't have your long Bitcoin exposure anymore, especially with leverage. And the amazing thing is institutions have really adopted it. You can see like there are a lot of strategies that could go around trading perpetuals, including their funding rates, combining with options. For example, if you have a very high funding rate, you might want to try and be put in a situation where you can capture that, being long the perpetual, but then you don't want the risk of price movement, so you might sell some calls against that. There's a lot of interesting institutional kind of strategies that can play around it, and I think they've really embraced this. The whole calculations of funding, how you can, and I think the main thing that they love about perpetuals is you've got a very similar product across all these different exchanges with very high liquidity. So a lot of volume, a lot of, the order book is full of just great volume to hedge your trades. And then you have a lot of strategies around that you might look to do future spreads with those perpetuals and the dated futures. So yeah, they're here to stay, and I think institutions love them.
Yeah, and in the more traditional markets, the whole term structure and derivatives complex more built around futures. Maybe Payal, you can talk more about like where the differences are there when you're using essentially futures as the base of the term structure rather than perpetuals.
Yeah, well, I love to disagree with this one, right? So I think perpetuals, 100%, right? They've got a place in the market, and to their credit, they've seen a great uptake. But if we go back, the reason that some of these perpetuals came to market was to maybe sidestep regulation a little bit. So when we look at our markets and regulated by the CFTC, a future has to have an end date. Yes, that also means, especially with retail, you have to deal with the roll, you have to deal with that expiry, but that's what risk management is about, right? Having that especially with CME futures, the convergence with the underlying index to the future at a specific date in the future. So if we take away that expiry, we're then getting into kind of the swaps world, and that's a whole different asset class. So from an institutional side, I don't know if, what the feedback that we're seeing is growth in futures, and whether is there an institutional interest for perps, and what do they actually solve that futures don't. And so we're seeing that in our numbers. So if you look at large open interest holders, which is a great metric that the CFTC actually put out, and that's a show of participation. And what this number represents, so large open interest holder is any holder, any trader that has more than 25 contracts. And so for Bitcoin, we have over 120 large open interest holders. And so if you multiply that into the contract, one Bitcoin contract for CME is 5 Bitcoin. So anyone that's holding 25 contracts of a 5 Bitcoin contract, so that's 125 Bitcoin equivalent. So that's what, 1.3 million dollars in today's money. And to have 110 such holders, or if you look across the suite for Bitcoin and Ether, for micro and standard, that's about 430 such large open interest holders. So if we're seeing institutional demand because of that large open interest holders, that's in futures. I don't know if there is a need for regulated or for perps that we're seeing. And I guess, for the other thing with futures, and with CME, having that 180-year-old history and having the other 6 asset classes, we're now actually seeing crypto nascents that came to CME to trade crypto to begin with are now looking at other asset classes. So we have folks that are now trading in gold or using the correlation with the NASDAQ and the tech-heavy stocks. So we're now seeing that activity into the other products, or margin offsets where they want to do a strategy between Bitcoin and Ether, or in fact, trading CME or trading Deribit and the ARB opportunities that exist there. So I think it's a great for the ecosystem, but for us, I think it's more on the future side.
So you're not going to be introducing perps anytime soon?
Not this year.
Hey, and John, and maybe you can say a bit more about one big constraint that's still in that regulated market is just that it's a cash margin market, and the more natural trade would be collateralized with Bitcoin and sell futures against that. Is that something you can bring to market, and how will that change maybe future term structures even?
Yeah, I think one of the big differentiating factors between kind of the U.S. Derivatives market and what we see being offered internationally, I think, is this concept of portfolio margining or cross margin, maybe, where you're able to get offsets between your perps or your options and your cash coin kind of balance on the exchange, whether it's Bitcoin or ETH. You can't get that in the U.S. markets today. It's either dollar collateral or other types of collateral that you can deposit at a clearinghouse, call it U.S. Treasuries or other types of highly liquid securities that come with haircuts and things like that. And so for a crypto native firm that maybe doesn't have a big balance sheet or a big treasury or isn't trading in a lot of other asset classes, that increases the cost of capital substantially to trade in U.S. markets. Right? Think of if you're holding long a tremendous amount of Bitcoin and you want to short futures in the U.S., you actually have to deliver dollars to your FCM, who then delivers dollars to the clearinghouse, even though you're holding a bunch of BTC where you're effectively positioned as almost potentially net flat. That doesn't make a lot of sense from a trader's perspective. And so I think one of the things that we're focused on in the future, given we have a fully regulated spot market, and now an approved clearinghouse to be able to offer margin is how do we bring those two together? Right, so we're one of the first clearinghouses in the U.S. that natively operates digital wallet infrastructure for the purposes of our spot market. So how can we work with the regulator to bring these capital efficiencies in a prudent, governance-heavy, very transparent way that makes the regulator comfortable, but also brings the rest of the market infrastructure with it? I think is really important, and I think it's the last piece I think is also really important here is, as a clearinghouse, I can't just wave the white flag and say wave a flag and say I'm open for business, bring your Bitcoin, because there's a massive amount of infrastructure behind that needs to be brought into light that currently doesn't support this market either, right? So in the U.S., as a clearinghouse that provides leverage, it's an intermediated model, meaning you have to have an intermediary futures commission merchant in between the clearinghouse and the participant. That's effectively guaranteeing those trades and depositing money in the clearinghouse. Whereas internationally, it's a very direct model. And those FCMs have to hold the Bitcoin to deposit it in the clearinghouse. The direct participant can't. And there's this thing called SAB 121, which anyone that's in the US and in crypto understands is if you're effectively a custodian or fiduciary for crypto, you have to reflect that on your balance sheet as a liability. And what that automatically does is it creates a huge burden for those institutions to build a business model around actually putting that as a liability, because now you have to have an offsetting asset, right? When you have to park capital for the purposes of that liability, which then obviously creates a cost to the business. So it's not just, hey, let's accept crypto as collateral. It's how do we bring the rest of the market infrastructure along with it in the US? So a lot to do, but I think a large amount of benefit to bring if we're able to solve it.
Yeah. So then it sounds like this sort of bifurcated market structure will still persist for some time with a lot of like risk reduction benefits in traditional clouds, but still lacking a little bit of that innovation from in the non-US markets. Maybe Shaun, quickly, if perpetuals are here to stay, do you have dreams of like a perpetual 2.0 or like ways to really further innovate on the concept?
Well, there could be volatility index perpetuals. That would be an interesting one. Funding rate based on volatility. So we launched volatility index futures a year ago, and I think there will be more and more in crypto. I'm not sure where it will happen. I mean, you've seen DeFi, you've seen NFTs. If you can really think about NFT futures, options and stuff like that, we're not thinking in that direction yet, because for us it's really about making sure that whatever product we bring to market is something that clients want. We just don't want to spam them with lots of different altcoins and stuff like that. That's why we've held only Bitcoin and Ethereum options for a long time, since inception, just Bitcoin options, and then Ethereum came shortly afterwards, and now we're going to expand that to a handful of altcoins, because altcoins, you don't know if they're going to be there in 5 years. You want a product that has to be there, and now it's kind of stood the test of time. It's time to start bringing those in, and I think the innovation will happen. I think more in the DeFi space, actually. I think there's like levels of innovation. Yeah. I mean, especially the very regulated exchanges, they are limited. They're limited by obviously all these constraints with regulation. Us as, let's say, self-regulated, we can innovate a bit faster, and then with DeFi you can do everything pretty much. And it'll be interesting how regulation deals with that.
Yeah, definitely, and that's a good segue, I think, into maybe the broader question for each of you of, you've come a long way in developing maturity, but there's still probably gaps in regulatory clarity, market infrastructure, in risk infrastructure. So maybe give a view on where, let's say, that the parts of the derivatives complex have really matured and sort of are meeting the experience levels in other asset classes, and where we're still falling short.
Yeah, I mean, we're starting to introduce functionality that we see in traditional marketplaces, so in equities or fixed income, so things like basis trade at index close, so BTIC or TAS, especially important when for an ETF, for example, where they want that guarantee on the close. So a BTIC transaction might be really useful so that someone could guarantee the entry point into the futures based on the underlying index. So BTIC, the same with TAS, so trade at settlement. So we're starting to implement the things that we see in traditional markets into crypto. And to your point, innovation is key. So last year we ran at a cadence of introducing one new crypto product reference rate a month. We've calmed down a little bit, but in terms of volatility, now that we're at 2-year lows in terms of volatility, where does that market movement come from? So we recently launched Ether Bitcoin ratio futures, which really allow participants to, rather than taking a directional view on Bitcoin or Ether, the relative strength. And with so much going on, with like the halvening, the flippening, where will the next ETF application be? Will it be spot? We just saw Ether come through. So allowing participants to take that more view of one versus the other. And so those are the kind of things that we're trying to innovate, still very much within Bitcoin and Ether. But I think it's amazing to see how far we've come, right? So we got into the space 2015. We launched our first Bitcoin futures contract in December 2017. And at that point, we were doing 1,000 contracts a day. Now we're doing 10,000. We're doing 4 billion notional a day. So I think that innovation, yes, it has to be measured and it has to be client-driven, but it's also how do we grow that ecosystem? How do we bring those traditional things into the marketplace that allow for risk offset? So some of the things that we're seeing.
Yeah, maybe John, you've of course re-entered the space in a way after being an early mover, so you probably have a thorough look at what happened in the last 5 years.
Yeah, I mean, I think along with CME, Cboe launched futures on Bitcoin in 2017. I think we were all aligned on how fast we could bring it to market. And we've re-entered with the acquisition of ErisX, now called Cboe Digital, and our plans to list futures on Bitcoin and ETH later this year. And I think, part of it is timing, part of it is product. Right, I think, from an institutional perspective, I think, we definitely can agree that we see growing demand in we'll call them classic futures, expiration-based futures. I kind of sit in the middle of the two here in the sense that I think there's a place for perpetuals when you consider the yield curve. As the farther out you get in the curve, the harder it is to find natural demand in the market. We call it 1, 2, 5-year based futures. We could create a 5-year based BTC future. It would probably look very similar to perpetuals, but it wouldn't be exactly the same. So I view a place for that. We see a lot of demand for basis trading. I think that's really interesting. But I think also what we're focused on is how we can innovate from a product perspective that fits the ecosystem. So we talked about perpetuals and its institutional adoption, but it was really driven by retail first, right? So it was a very retail-driven product to start. And then institutions started getting into it, driving more and more liquidity. And so when I go to an institutional participant and say, hey, got this idea, the question is, what's the ecosystem look like? What's the natural, who are the natural users? Is it hedgers? Do we think retail is going to be involved? Are there large, industry or institutional-based interests, call it like miners, as an example? What's that ecosystem look, and is it vibrant, right? It can't just be high-frequency trading firms and market makers trading against each other. That's not sustainable, right? So focused on how we bring those types of products to market. And in the US, it's interesting because perpetuals are swaps. Swaps are not a retail accessible product in the US, right? So being able to bring a product like a perpetual to the US where there probably is large amounts of retail demand, I think is tricky because the entire market infrastructure, again, behind it does not deal in swaps. So then going to them and saying, hey, we want to list a swap and we want you to support it, there's a mountain of governance and reporting and additional kind of licensing and regulatory requirements they have to deal with just for one product. And so again, there's an opportunity cost. Do I do this? Do I do that? And so how you create a product that fits within existing regs, but also gives you breadth of ecosystem is a really big challenge, specifically in the US, the way the regulatory framework works. And so I think that's why we see really long timelines. You come up with a product and it takes months, years for it to fully kind of evolve versus just standing up a product and seeing large scale, kind of support. Whereas, maybe internationally, there's more flexibility. You might be able to be a little bit more nimble. So I think we'll still see quite a bit of innovation internationally. I think in the US we'll continue to lag that a little bit, but to our own benefit, I think as we bring products to market as an industry, right, they'll be battle tested, regulatory approved, and you'll see larger involvement from institutions earlier because of those points.
Yeah. Hey, and Shaun, you're making the move with Deribit to Dubai then, and finding a regulatory home, maybe a bit less restrictive than the US. Talk us more about like that regulatory strategy.
Yeah, so as I mentioned, I think regulation is becoming more and more of an important theme to foster greater institutional adoption, especially after the events of FTX, or it's just accelerated that. So we are going for the VARA regulation in Dubai. I think we just feel it has the right balance. So you don't want something that is just like, do whatever you want because clients won't trust you and it defeats the purpose of it. And you don't want something like, which is too strict that it stifles all kind of innovation, all kind of understanding of crypto and how this industry is evolving. So I think Dubai has that right balance, and that's why we've I think, and not only us, a lot of other native crypto exchanges pursuing that because they feel that it's the right time, and maybe that grows from Dubai, especially once a lot of more regions get more clarity on what they want to do and which direction they want to take. I mean, the EU has put out its framework with kind of MiCA, and that's always good when somebody just says, hey, these are the rules. But I think that's still an evolving, evolving industry as they kind of understand what are the participants wanting, what is the right balance to not just kind of stop the growth in crypto.
And that's maybe a good point in discussion to look a little bit also more at risk. I think traditionally we've always talked about risk in derivatives as leverage multipliers, but really in an institutional setting where most positions are portfolio margined and where a lot of the 100x leverage days are essentially more of a thing in the past or very contained. I think it's actually much more the non-market risks, right, that are still prevalent in crypto and really are the things you should be worried about as a derivatives trader, right? Things like settlement risk, things like operational outages. And that's where we're left to wonder, will also this non-US space where you have these exchanges that are actually bundles of being a broker, an exchange, but also their own clearinghouse. Yeah. And they're sort of bundling everything with sometimes questionable governance. Do you see then the path for that side of the market to actually start unbundling, similar as it works in the US?
Yeah, for sure. I mean, I think for it to be unbundled, you need willingness from clearing to take this on. So I don't think all these native crypto exchanges did it by choice, but necessity, that they had to build the whole risk framework, margining, and not just be just an exchange. It's really, I mean, in some ways, I think it's also brought some innovation to it. I mean, we do real-time risk calculations. So every order that goes in, you're getting a risk check at that point. And the gap risk is a lot less because of this. So with clearing, you might get a call later on, a few hours after you've breached your risk limits. Hey, you need to reduce your position here, or we'll have to take some action. Whereas in crypto, it's just straight away. There's no call. You'll get an email when your initial margin gets hit, and you'll get liquidated straight away. And what this actually allows is it allows a certain capital efficiency. So there's capital efficiency in having clearing between netting, let's say, a long future position on Deribit versus a short future position on Binance, but which users cannot do right now. So that's kind of inefficient. But on the other side, because of this real-time liquidation, you can actually charge less margin for those positions. And I think that's where maybe a lot of participants get worried when they see this leverage. They don't realize actually, if you look at that leverage in conjunction with how quick the exchange will deal with it, it's a different ballgame. And 24/7, I think that's one thing that also reduces the risk quite significantly. So.
But should the non-US exchanges maybe just start working together on the joint clearinghouse and just?
I think there are probably talks right now that going on trying to do something along those lines. I don't think the appetite is really like fully there. I don't think crypto is yet on that same level as the traditional markets, the volumes that you see there, but it is becoming much harder to ignore, I think, for them.
Because looping back to something I think you alluded to in the beginning, Payal, is arbitrage between these more trusted and untrusted markets, and of course the prevalence between retail and institution. It will create very interesting arbitrage opportunities, but how can you actually exploit them? I think prime brokerage is, for instance, something that's never really yet developed. It's been talked about for years. How do we see that those sort of players actually finally be able to facilitate arbitrage?
Yeah, and I think it's exactly that. It's the evolution of prime brokerage. It's the better use of capital efficiency. So futures are one of the most efficient ways of managing risk. But for crypto futures, of course, with the margin, they're not as efficient as what we see in equity markets or FX markets. So that the evolution of a prime brokerage, or the evolution of more liquidity providers, market makers, FCMs in our world, just additional points within that chain, I think will make some of those frictions be reduced. And you made the great point about regulation. Certainly with Mika over here, our futures are able to be traded globally, and we actually see. Although being a US exchange, we see more than 50% of our volume coming from outside of the US. So that's non-US hours or coming from a non-US counterparty. So that really shows that it's a global mousetrap, that it's got global presence. And some of the things that we're looking at is creating very local offerings. So where there is a need for risk management, maybe in APAC hours or in the afternoon over here, or US hours, having those reference rates that we spoke to, but a local version of those. So more ways to mitigate risk. So you can have multiple margin calls, but also having not just a one-time snap of your reference rate or your price, but actually throughout the day, so that it's more global and bringing those more localized products to market.
Okay, and John, anything to add to the discussion?
I mean, I think echo some of the sentiments. I think it's the models are different, right? International versus US. I think I definitely echo. I think central clearing has a lot of benefits, though maybe some view it as antiquated technology and processes. I think the benefits of some of the technology that's underneath some of these assets that we're talking about trading in the derivatives market. There's, I think, a lot of opportunity for clearinghouses and for traditional players to integrate that technology to make their processes more efficient. Talk about settlement and margin calculations and things like that happen in maybe some of our more traditional assets. We might be able to bring forward and do quicker and do maybe more atomically by leveraging this technology. So I see these worlds kind of converging over time. How and where and what the drivers are, I think, still yet to be seen.
Okay.
Yeah, I think they're less. It's not two separate worlds. It's not the regulated and unregulated. I feel like they're coming closer. And some of the things that that we've learned in terms of the speed of innovation, but having that balanced by with the more regulated market, not having to worry about auto liquidations or having those checks and balances in place, so that we have. The checks and balances that if the market moves too quickly, too fast, that we can actually stop and halt the market to prevent auto liquidations, and there isn't that concentration, position limits. So bringing some of those things that is so normal in our world, in the regulated world, to now start hearing that in the nascent side, I think is quite endearing for just growing the ecosystem.
Excellent, and with that we are just about out of time. I think that's an excellent thought to wrap it up. Yeah, thank you so much for joining us today.
Thank you.
Thank you.